Hello and welcome to your Recipe for Financial Success with me, Emma, and my colleagues Becky and Julie.
In each episode, we'll be bringing you a list of ingredients to help you cook up a storm and master methods to finesse your finances. We'll be helping you expand your repertoire and hopefully teach you a few new skills along the way.
So, clear the counters and get your mixing bowls ready for today's recipe. Let's get started.
Can you hear them jingle bells, girls? Are you all ready for Christmas? It's getting close now.
It is indeed. I'm dying to ask you, Emma, have you done any Christmas baking yet?
Well, I've cheated a little bit this year.
Go on.
That I've tried to make a gingerbread house before and my gingerbread was a disaster and it didn't hold the structure. So I've been clever this year and bought the gingerbread biscuits. So I've just been decorating it.
Good
so
thinking.
We can share a nice picture of that one, I'm sure.
Excellent. I shall look forward to seeing it and hopefully eating a bit as well.
Well, of course, I'll let you try a little bit.
Thank you very much. So in today's episode, we are going to be whipping up all of the ingredients that you need to put in place some life cover. So, Emma, do you want to start off by telling us what life cover is for?
Of course I can. So life cover is designed that it's going to pay out if you die, basically. So not necessarily the cheeriest of subjects, but it's obviously an important thing to talk about. So when you die, it's designed that it'll pay out a lump sum to your loved ones even, which is going to make life easier for them, basically. Obviously, if your income stopped or they haven't got any money coming from you anymore, obviously they're going to possibly be financially dependent on you and they're going to need some extra money. So it just kind of gives them another start to their life, basically.
Well, so why should I have life cover?
Well, if you have pets, would you have insurance for your pets?
Yeah, I would do.
I used to for my cat, yes.
Yeah. So would you say you value your pet's life more than your own?
No, probably not.
No? Tricky question for some people, though, maybe. And pet insurance can sometimes be incredibly expensive, but it's something that we wouldn't go without and we'd make sure that we have in place to make sure that we could afford to look after our pets. So why wouldn't you do it for yourself too?
That's a very good point. Why wouldn't you, Emma?
Well, hopefully today we're going to answer some questions about why you would put it in place, and it might get you thinking. It might be something you look to do now. When you're thinking about life cover, there's 3 different things that you'd need to think about of reasons that you might look to put the life cover in place. So those 3 things all begin with D. We've probably spoken about these before. So the 3 Ds are debts, dependents, and death duties. So what those 3 things are whether you have, say, an outstanding mortgage or any credit cards, car finance that would need to be paid off should you die. The dependents are if you've got anyone financially dependent on you, so whether that be a child or a husband or wife, another member of your family, even someone that you've just always looked out for and always given some money to on a regular basis to help them out. If you're not there to continue doing that for them, who's going to? And then the final one is death duty. So when you die, are there any extra things that need to be paid? Maybe you've got an inheritance tax liability or something like that needs to be paid, that by having some life cover in place could pay out to cover that liability.
And also to pay for a funeral. In some cases, people don't have enough savings to actually cover the funeral costs. Certainly with all these crowdfunding funerals we've seen recently.
That's very true. Really good point there, Julie. So there's several different things that you'd need to consider when looking at life cover as to have you got cover in place for that, or would you need something to pay out to provide that cover when you're gone? We've talked about, obviously, the importance of reviewing financial affairs in the correct order before. So when we talked about PIPSI, which you may want to go back and listen to if you haven't listened to it recently. And several years ago, one of my colleagues met a gentleman and he basically came to us and said that he wanted to invest £100 a month into an ISA. So we went through all the steps that we would normally do to find out about all of his circumstances. And during our discussion, we found that he had no life cover in place. But he did have a wife and he had a young daughter. So during our conversation, one of the things that we recommended at the time was that he considered putting life cover in place. But he completely refused to do so. he decided that his priority was still his ISA. So an ISA was set up and he started making contributions into there. So after 3 months of paying in £100, he completely unexpectedly died, which nobody would have ever imagined would happen. But that left his family in absolute turmoil because all they then had was £300 that he'd saved into an ISA. Whereas if he'd have set up a life cover policy, obviously depending on the cover he'd have put in place, he could have had a lot more money paid out to them. He could have had thousands possibly go to them, which could have changed their lives and set them up for the future. So it just goes to show that, one, hindsight is a wonderful thing. If we knew about what was going to happen in the future, we'd obviously make sure we do things now to obviously stop things like that happening. But it just goes to show the importance of having things in place because we just don't know what's going to happen. And there is something you could do about it.
Definitely. So for our listeners who are thinking, if that happened to me, what would happen? What would you say would be the first thing for them to think about when they decide, how much cover do I need, for example?
Okay. So when you think about how much cover you need, it can depend on lots of different things. So say you're worried about if you die that you've got a mortgage and that's what would need to be paid off. And if that was paid off, your family could live comfortably, then possibly the cover you're looking for would be an amount equivalent to your mortgage. Or it could be that your children are, say, 10 years old and you want to make sure that they'll be financially secure until they're 25 and have left home. You might be thinking that you need cover equivalent to your income. So say your income was £20,000 a year, you might think I need £20,000 times 15, which is going to take them to the age of 25, and that's how much cover you would need to see them through. So there's not always a right or wrong answer for how much cover you do need. It depends on your circumstances. But there are things like Aviva's life cover calculator, where you can go on and put in kind of a few details and it'll help you to give you an idea of what kind of cover you might need in place. Just as an example, the average household with a mortgage owes around £125,860 at the moment. I say roughly the amounts there, that seems pretty accurate, but that's the information we've found. So obviously that could be the amount that you would need in place for a mortgage if you were that stereotypical average person. And also the average funeral cost at the moment is £4,267. So as Julie mentioned earlier about people not necessarily having enough savings for funerals, if that was what your priority was, you could have cover in place to cover the average cost of a funeral. So yeah, basically, it depends on your circumstances how much cover you would need, but that's one of the first things to consider when looking at your life cover.
And what about how long the cover should last for?
So again, you need to think about your circumstances. So if, as I said, maybe you're looking at it to pay off your mortgage, you might be thinking, well, my mortgage has got a 25-year term and at that point it'll be paid off, so then it wouldn't be a liability I'd be worried about. You might want your life cover to last 25 years to match the term of your mortgage. Or it might be, as I said, about when your children are going to reach financial independence. So what age do you expect that to be? Would it be 18, 21, 25? It could be older. It entirely depends on your family and your situation. And it's basically making sure it's going to last for as long as that the liabilities that you want covered exist. It may even be 5-10 years. It doesn't necessarily have to be a very, very long term. It can be a short term, but having that cover to cover that is really important for you.
So is life cover like individual, or would you do it on, so like say for example, if you're a married couple, would you do it on for both of you together, or do you have one each?
So you've got the option completely to do what you like. So it can be on a single life basis or a joint life basis. And if it's on a joint life basis, you have the option of it being paying out either on first death or second death. So as an example, if you have a joint mortgage and you want that mortgage to be paid off immediately if one of you were to die, you could have that set up on a joint life first death. So as soon as the first person dies, that money would be paid out and would pay off your mortgage. Whereas an example of when you might use a second joint life second death policy would be an inheritance tax liability, because you only pay the inheritance tax when the second person has died, so you wouldn't need that money to pay out on the first death. You'd want it when the second of you has died, and then it would pay out to potentially cover your liability.
So if I take out a life cover policy today, will the amount that I'm covered for, will that always stay the same, or will it change throughout the duration of the policy?
That's a good question, Becky. So you could either have your policy, so it's just a level policy that's going to pay out the same amount on day one as it would at the end. So obviously you've got to take into account things like inflation. The buying power of that money would lose value if it was set up in that way. But you could have what we call an index-linked policy. So what that means is it's going to go up in value over the period of time that you have the policy. So we talked about that in Banks and Building Societies about inflation and how it can affect the buying power of things. So having that indexation linked to your policy can mean that it's going to obviously have the buying power in the future as it would today, which can be really beneficial for you.
What about a policy that goes the other way then? If I can have one that goes up in value, can I have one that goes the other way?
You can. So what that would be is a decreasing term policy. So what that does is, say at the start of your policy you have £100,000, and say you want it to match up to your mortgage. So over a period of say 10 years, your mortgage is going to go from £100,000 down to zero, because that's when it's going to be paid off. You may choose to take out a policy that's going to reduce each year, so that the level of cover goes down, so that, say you made a claim in 9 years' time, it might only pay out, say, £15,000, but it's still going to completely clear all of the remaining liability you have with your mortgage.
So I had a friend who died, and her family then got a quarterly payment afterwards, but that doesn't sound like what you've just described. What's one of those plans?
What your friend probably had is what we call a family income benefit policy. So the difference between a life cover policy and a family income benefit policy is the family income benefit is going to pay you regularly a set amount for a fixed period of time, rather than one lump sum at the time of death. So this may be a really good way if, in my example earlier where I talked about having financial dependence and you wanted to replace your income for X amount of years until they reach financial independence, this way, rather than having a lump sum all at the beginning, you've got to make to last until, say, they reach 25, you'll have a regular income, in this case on a quarterly basis, that you can then use for the purposes that you need to use it for.
Would that plan be a lot cheaper than a level term assurance?
So they do tend to be cheaper, because the difference being with a level term assurance, on day one you'd get £100,000, and say 10 years later you'd get £100,000. Whereas the family income benefit, what happens is it reduces over the 10-year period. So say you wanted it to pay out £10,000 a year, in year one you'd get £100,000. But if you made a claim in year 3, it would be £30,000 less, because it's been running for 3 years. So it reduces by that amount each year, basically. I hope I've explained that well.
No, that's really good, Emma. Thank you. So what happens if you don't die?
So if you don't die and you get to the end of the term of the policy, that basically just means the policy ends and that's it. You don't get anything from it.
Oh, okay. So what about if I get ill? I mean, and I know you did income protection the other week, but if say I got ill with like something like I don't know, like cancer or something like that, what would happen then? Is there something that would cover me for that?
So you have the option to be able to add things to a life cover policy, one of those being critical illness. So what that then means is that your policy would pay out on diagnosis of a critical illness or on death, or sometimes, depending on the type of policy you've got, it may even pay out in both scenarios. So if you were to, say, be diagnosed with cancer or any one of the illnesses that would be on the provider's set list of illnesses that they would cover, then however much you are covered for at the time would be paid out at that time of diagnosis.
Presumably there's a difference in how much the critical illness cover costs compared to the life cover then?
Yeah, so if you add the critical illness onto a life cover policy, obviously it is going to bump the premiums up slightly, but obviously you have got an increased level of cover, so it's going to be able to pay out in more than one circumstance possibly. So it's obviously an extra benefit. You would expect to pay more for it.
So do different providers pay out for different illnesses?
Yeah, so most of them have a standard set of illnesses that they will pay out for, but sometimes you can find ones that will cover kind of special conditions or anything like that. So if you're looking for something that covers a lot more, obviously you'd need to look into the details of the policy to see what it does cover. But if they cover more, they tend to charge a little bit more for it as well. So obviously something worth looking at.
And how do I get life cover?
There's lots of different ways you can get life cover. You could go online and there's comparison sites, or you can go direct to providers online. You can probably phone up different providers if you've still got a trusty old phone book that you like to have a flick through. I'm sure there's a number in there. Or you could obviously speak to a financial advisor. An independent financial advisor would be able to look at the whole market and basically do some research for you and tell you what offers there are out there.
Excellent. So you told us actually a bit of a sad story earlier on. Have you got a nicer, lighter story to end the episode with?
Yes, I have. So we have some clients that took out a life cover policy with critical illness. They weren't particularly old. They were quite young clients, actually. And were obviously out of the blue, because nobody ever expects it, diagnosed with terminal cancer. And what happened was the critical illness part paid out immediately. What that then meant is obviously they could still go out and enjoy things and do things while they were well enough. They could go, whether it be Disneyland, Paris with the children or anywhere, and do the things they wanted because they then had the money to be able to do it. It kind of freed things up for them so they could do that, and meant that they could make memories together and have happy times before obviously the inevitable was going to happen. So they got to make all these happy memories and do all these things together. And then, sadly, when they did pass away, there was actually the life cover part that paid out as well. So on their death, a second lump sum was paid off, which meant the mortgage was paid off fully. And that the family was basically set up for life because there was no mortgage, which they were expecting to have to continue paying for a considerable number of years. That was then paid off, so they could basically continue to live their life and had all these happy memories to kind of continue with.
Excellent. Thank you for that, Emma.
That was great, Emma. And I know we've got another episode lined up to discuss life cover in businesses on another occasion.
We certainly have.
I think that rounds us up for the day. So thanks ever so much, Emma, for giving us the whistle-stop tour in the fried green tomato cafe of life cover.
Very good. And with that, we've completed today's recipe. We hope you have enjoyed following along with us today and cooking yourself one recipe closer to a financially secure future.
If you'd enjoyed today's podcast, you can head over to www.recipeforfinancialsuccess.co.uk, where you can find out more information and a full list of ingredients on today's recipe.
For more hints, tips and tasters, find us on Facebook at Your Recipe for Financial Success. Thank you for listening and see you next time.